Welcome everyone, and thank you for joining our webinar. Today we will be discussing the current state of the DSO market. A few things to keep in mind. All attendee lines are muted throughout the presentation. At the end of the presentation, there will be time for questions. You can ask questions by typing within the Q&A section, which is located in the control bar. This can be found either at the top or bottom of your screen. This webinar will be recorded and it will be distributed next week. Today's speakers include John Jones, who's a partner at Pepper Hamilton, Michael Patton, who's a managing director at Provident Healthcare Partners, and AJ Shekar, who is a vice president at Provident Healthcare Partners. I will now turn it over to Michael Patton to give an overview of Provident Healthcare Partners.
Good afternoon, everyone, and thanks for joining today. Provident Healthcare Partners is a healthcare-focused investment banking firm headquartered in Boston, Massachusetts. We concentrate on sell-side mandates, primarily with founder-owned businesses that are looking to partner with either private equity sponsors or strategic consolidators. We have focused since the inception of the firm on healthcare services, and more recently have, due to market dynamics and appetite for opportunities in the practice management space, we have done over 49 transactions in practice management over the last 5 years. The single specialties those range from are outlined on the slide here: dental services, eye, urology, gastroenterology, kind of all of the single specialty spaces, as well as a number of transactions in multi-specialty and ambulatory surgery centers as well. Provident has 24 investment professionals amongst 2 offices. Our primary headquarters is based in Boston, and we also have another location in Los Angeles, California. We've done, deals throughout the 49 deals we've done in the practice management space. We've kind of come across every hurdle that you could think of based on the shareholder bases that we deal with. We've done transactions ranging from single shareholder businesses to 148 shareholders in one of our most recent transactions. We've also had extensive experience in the dental health space, completing 4 transactions in that space, both single state and multi-space, all multiple location deals. I'll pass it on to John Jones from Pepper Hamilton to give an overview of Pepper.
Thanks, Michael. Pepper Hamilton is a full-service law firm with a unique focus in healthcare. Our healthcare transaction practice, with over 25 lawyers committed to healthcare, 75 of whom are focused primarily on healthcare transactions. Our value proposition, unlike many firms, is we bring together the corporate M&A piece with the healthcare regulatory piece, which you'll see today, in a one-stop shop. We've handled many physician practice management deals in a number of specialties like Provident, and several DSO transactions over the last 5 years. I will now turn it over to AJ to talk about the DSO industry.
Thanks, John. As a quick overview on some of the trends and transactions we're seeing in the DSO market, we thought it'd be helpful to give some of our listeners with a brief overview on some of the trends that are affecting consolidation within the market today. As kind of a quick starting point, what we've continued to see within the dental services market is a continued projected increase in dental expenditures year over year, with a compound annual growth rate expected of about 5.1% leading up to estimated year 2025. In addition to kind of this continued projected increase in demand for dental services and expenditure on dental services as well, we've continued to notice a highly fragmented market where there are a number of smaller independent providers with only the very largest consolidators making up a small portion of the overall market share. We believe these 2 attributes are going to continue to influence transaction activity within the dental services space, especially to private equity firms who are really serving as the catalyst for consolidation within the sector, and have really done so over the past 20 to 30 years within the dental services space. What we're anticipating with these trends is that private equity firms can not only back existing dental services organizations for organic growth in order to capture some of the increased expenditures within the dental services market, especially as we're seeing an increase in awareness of oral health, as well as increased demand for cosmetically related services, but also an opportunity to consolidate some of the independent practices that dominate the landscape, especially as the shareholders of those businesses seek transition opportunities, but also seek to mitigate risk in terms of the ongoing need for IT infrastructure, compliance, and other services that detract from what many dentist shareholders kind of view as their core competencies around kind of providing dental services and quality dental care. So we believe that, again, at a macroeconomic view, these factors will continue to influence consolidation within the market. Next slide, please. And we've really seen some of these trends play out over the past several quarters in terms of the overall profile of consolidation activity within the sector. As recently, even as Q1 2019, we've seen a heavy influx of both private equity firms committing capital to existing DSO platforms to kind of aid in their growth and consolidation efforts, but also existing dental services organizations that are backed by private equity seeking to make acquisitions of independent players to expand their geographic footprint or even expand into new markets. I think what we'll continue to see, as evidenced by some of the transaction activity we have listed on the right, on the left, is that strategic consolidators will heavily leverage add-on M&A activity because it tends to be, some of the most kind of accretive and quick ways to expand market share within their existing geographies, but also given the fact that there is so much capital out there being allocated towards healthcare services, and that the dental services segment has long remained kind of an attractive area for private equity investors, given that number of avenues of growth opportunities and also eventual exit opportunities that, the continuing influx of new consolidators within the sector should offer good avenues for independent organizations to evaluate potential transaction options, whether that's to join an existing DSO or potentially become a private equity platform of their own. And I think just kind of a last point on this DSO market activity slide is that as we continue to see kind of more competition from private equity firms bidding on transactions alongside strategic acquirers, we expect that valuations will remain steady, if not elevated, with creative deal structures to match shareholder considerations, but also business performance. Next slide, please.
And so this slide gives us an overview of kind of when we're kind of been engaged on an engagement, the different types of strategies for DSOs as they approach the market. And obviously, it's not one size fits all. It all depends on the particular company and kind of the overall look of the business and what the seller ultimately wants in a transaction. Option number one outlines kind of the national consolidators, those such as Heartland, Smile Brands, who already have a built-out infrastructure and footprint, throughout the country. Typically are consolidating a lot of the back office operations, leveraging their scale with payers. This is, there's an option for sellers who are looking to do a 100% transaction to exit completely, or to exit and have, a potential earnout in a transaction. Also, typically there's more likely some synergies and redundant activities that can be eliminated in those types of transactions. The second bucket is, as we've outlined here, with 42 North Dental and Western being kind of examples in that space, 42 North being backed by Audax and Western being backed by New Mountain Capital, are platforms that are a potential partner for someone looking to do a transaction where they can be either a geographic platform where the company doesn't have a footprint, or an expansion of the existing geographies that the group is operating in. And in those situations, typically there are some synergies, but there's also the ability to join a group and to still have some autonomy and ownership with the private equity partner in place. And then the kind of the third bucket there is being a pure play private equity platform, and that's where you're going in and partnering up with a PE firm, and you are the foundation that they're going to grow off of. They're going to build off of your systems, your payer relationships, and likely come in and augment the management team, help you do additional acquisitions, give you the capital to do so, but also bring in some additional knowledge as it relates to whether it be people to put on the board who have gone through practice management transactions in another space, augment the kind of or have experience building out kind of back offices, and whether it doesn't have to be dental practice management, it could be another single specialty, but brings that expertise to the table, and they're going to likely build off your geography, but also look to go into other geographies. So I think that's kind of the three buckets that we look at as potential partners when we're working on a transaction in the space. Gene, I think you move to the next slide. I think this side, touches on kind of the attractiveness of a DSO platform from the buyer universe, whether it be option 1, 2, or 3 on the previous slide, and those things that are attractive to a potential partner. Obviously, the biggest, I think some of the biggest things is a diverse revenue platform, strong management team. Obviously, the ability to scale the infrastructure that's in place, the ability to report data, and I think obviously working in the lower middle market, these are some things that those in option 3, becoming a private equity platform, likely have some of these built out, but don't have it to the level of where a group would like it, and that's the value that a private equity firm brings to the table, is the ability to help them build out the management team. Build out the infrastructure as it relates to IT and EHR in order to be able to report data and report financial statements, or look at kind of the KPIs in a transaction. Additional items relate to, and it's different in different markets, whether it be primarily commercial payers or Medicaid, which is different as we've looked at in state by state, and also I think one of the areas that we've seen that is that a lot of groups are shy away from some of the Medicaid, but there is attractive Medicaid programs in certain states, and some of the pediatric programs in some states are comparable to the commercial insurance. AJ, you can feel free to chime in here as well.
Yeah, I think ultimately what groups look to find in terms of a potential DSO partner is, like Michael mentioned, having a lot of these attributes in place already, and essentially using the existing team and augmenting that as part of the growth process moving forward. On the next slide, Gina, could you please switch it over to slide 9? These are really options that I think groups should consider as they even entertain whether or not a transaction process is right for them. I think it really comes down to identifying shareholder motivations and also business opportunities that would align with the potential transaction strategy. I think from a shareholder motivation standpoint, it's important to consider what type of transaction is kind of best situated to satisfy shareholder motivations. There's certain groups who really want to retain as much autonomy as possible over their business processes and kind of leading future growth and expansion. I think in those circumstances, sometimes it's best to think about maybe serving as that, either regional platform for a existing DSO consolidator, or potentially as a private equity platform of its own. I think in other cases, there are shareholders who are thinking about how best to kind of motivate and incentivize a wide array of ages as part of a transaction process, and kind of influences the time horizon for various individuals that are going through a transaction process. I think those can be, often, negotiated, but also accounted for in terms of having the existing shareholders roll over equity into the business. But certainly, I think a good consideration for any shareholder to have is, what's the level of autonomy I want to keep over kind of the business processes and growth moving forward, and how long do I, theoretically see myself staying with this business post-transaction. And really from a risk tolerance perspective as well, how much equity is the group kind of looking to monetize today versus retain moving forward. Some of that may be influenced by the ages of the shareholders. Others may be kind of more influenced by regional market dynamics. If, let's say, there are big competitors in the area, it might make sense to monetize more versus less. But I think it also comes down to the eventual partners in the business as well, from a private equity or DSO perspective. If the shareholders see a key opportunity to grow alongside the partner post-close, it may make sense to leave additional equity in the business to capture that upside growth opportunity in the future. And really, from kind of a business consideration standpoint, a good thing to evaluate before you even go through a transaction process is, just from a qualitative perspective, where can we grow with the assistance of a potential private equity firm or strategic partner? Do we foresee ourselves doing more add-on acquisitions, growing de novo, expanding service lines, et cetera? How do we think our management team can kind of stack up from a bandwidth perspective or a capacity standpoint to undertake this further expansion? If it's falling mostly on the shoulders of the shareholders who may be practicing clinicians at the same time, do we think about potentially moving on to the bringing in some of these individuals to help manage the growth of the business? And even from kind of a corporate infrastructure standpoint, do we have some of the systems and processes in place to grow this business alongside the resources of a potential partner? Next slide. And I think, once kind of the decision has been made to undergo a transaction process, whether that's in the short term or the long term, it's important to keep a few other considerations in mind from a strategic, operational, and financial perspective to ensure that a transaction process can move smoothly once kind of begun formally. And from a strategic standpoint, it's again, like I mentioned in the previous slide, identifying some of these growth opportunities that can be achievable with the help of a potential partner, but also just making sure that all of the shareholders are on board with the potential transaction. I think the last thing that groups want to have happen is, have a small cohort of the shareholders leading, transaction discussions and, potentially blindside some of the other partners within the business that may not be as up to speed on what's going on from a transaction standpoint, and making sure that all the stakeholders in the business are really on board for a transaction as well, from a kind of management team and associate dentist perspective. Really, in these businesses, the assets are kind of the revenue generators and the people. So any potential partner is going to want to make sure that those key, non-shareholder individuals are incentivized to stay with the business and continue growing alongside the private equity firm, but also the existing shareholders. From a operational perspective, it kind of comes down to having, the house in order to proceed with the transaction in an organized fashion. So first is kind of the team have the bandwidth to evaluate potential partners in an orderly format and an efficient standpoint. Sometimes, with especially clinically obligated shareholders, it might make sense to kind of put together a team or a transaction committee that can essentially inform the other shareholders in the business, but also kind of undergo the interview process needed to vet potential partners, whether that's private equity or strategic. And similarly, from a management standpoint, management being non-clinical management, having the bandwidth to answer the various requests from a due diligence standpoint, but also to properly vet the potential partners as well. And just from kind of an organizational perspective, having items like leases, articles of incorporation, employment agreements, payer agreements readily accessible definitely speeds up the transaction process once begun. But also from a statistical standpoint, having the ability to pull data from kind of a unit economic level from the practice management system to really look at trends on a individual basis, whether that's clinic level, provider level, even kind of code level from a procedure standpoint, to help fulfill a lot of the diligence requests that occur through a transaction process, but also to essentially drill down into the analytical details of the operations of the business on a unit basis. And lastly, from a financial consideration standpoint, it's important to make sure that the organization keeps the financials organized appropriately, thinking about not only clinic level financials on a monthly basis, but also on a consolidated enterprise level basis, thinking about what potential add backs and adjustments need to be made to the financial statements to really reflect the true adjusted EBITDA, which a transaction is based off of. And lastly, because most transactions involve, a private equity firm looking at the deal on an accrual basis versus a cash basis, which a lot of independent, lower middle market healthcare organizations keep their books and records on from a financial standpoint. It's important to think about what that accrual basis financial statement can look like to make sure that the adjusted EBITDA is in line with management's expectations, but also trending in the right direction to make a deal attractive not only to the broadest universe of potential partners, but also to the shareholders themselves from a deal proceeds standpoint.
Thanks, AJ. This is John Jones. I want to cover with you really the process, and AJ hit some points there at the end in terms of getting your house in order and preparing for a sale transaction. And that's the beginning. And you have a lot of decisions to make in the beginning. Do you want to sell? What are your partners thinking? Where are you in terms of the life cycle of your practice and company? And this is, is this a decision you want to make as a group? Because typically what I find is, the partners aren't always aligned in their thinking as to where the practice is today, where they want it to be, and whether or not they want to even entertain a sale. And so I want to walk you through some of the issues, both on the M&A side and the compliance side, that we see as some of the hot button issues. So next slide, please. If you're thinking about a sale transaction, you don't have to get your company ready for a sale and then sell it. And this is the biggest recommendation I always have, and I think Provident and Michael and AJ will agree. Even if it's a year or a year and a half down the road, start to look at your practice. And I know it's a tough thing to do and to think about that maybe you're not doing everything correctly, or maybe you let some of those organizational documents slide and not everyone has an employment agreement, and oh yeah, we promised so-and-so we were going to make him a partner, and yes, we've got a couple of retiring docs. No harm in doing it sooner rather than later. And that's the biggest piece of advice I think I could give in this presentation is if you're considering a sale transaction, make sure you're prepared. Because if you're prepared both on the legal and the financial side, it will be a smooth process. If you're unprepared, it could be quite a difficult and long process. So in terms of sell-side diligence, what are you looking at? You're looking at your corporate documents, you're looking at your compliance your equity documents, real estate agreements, as AJ mentioned, employment agreements. Everything should be buttoned up, right? No loose ends. And get your advisor in there just as if you were being bought, both the financial side and the legal side, and say, okay, get me ready to go. And that's what they'll do. And it could be anywhere from a 1-month process to a 3 or 6 month process. In terms of going out to market, you may have sensitive information, and once the deal starts, you may have to set up a clean room, and you're going to have a data room, but a separate clean team agreement and arrangement with the buyer in terms of, hey, it could be a strategic that's buying us. It may not be private equity, or it could be private equity with, already a platform, and we don't want them to see our competitive information. So it would be important for you to set that up. Next slide, please. So, let's talk a little bit about, you've kind of made the decision as a group to sell your practice, and you've prepared, you've brought your advisors in, everything's ready to go. You're ready to start the bid process. What does that mean? Well, if you're going to have an auction and you're going to put this out for bid, you really are looking for the best deal. And so you're going to have a bid instruction letter, which tells everyone, what rules to follow. All the bidders are going to execute an NDA. And then you're going to get these bid packages back, and you have to analyze them. And price isn't always the determining factor, because what you want to do is, when you get your bid packages back, you want to create kind of a chart in terms of, okay, here is the offer in terms of price. Here's the escrow. Here's the holdback. You may have rep and warranty insurance on another, from another bidder. And so you want to line all of that up and have the money guys, really, Michael and AJ, help you make that decision, right? You're walking through that and saying, well, I know this one says 100 million, this one says 75, but the 75 may actually be better, and here's why. So you got to go through that process. The attorney's going to consult with you in terms of your transaction team that you should have set up, and the board on the final bidder and the LOI, and negotiating that LOI. Keep in mind that once that LOI is signed, you're going to undertake the due diligence process with the buyer, hopefully a very smooth process, the quality of earnings with your financial guys, and potentially compliance audits. It's pretty typical in this space. Recognize this is why you want to do all of that work up front, that Q of E, diligence, compliance audits always impact structure of the transaction and purchase price. So to the extent that we can minimize any issues before we start the process, we want to. It makes for a smoother process. If your sponsor, if it's a sponsor deal, already has a platform and you're an add-on, or if it's a strategic, consider doing some high-level reverse diligence, financial, reputational, governance. Find out how they're operating that company, because you're going to become a part of that company. And you want to know if what they're telling you is accurate. Moving to the next slide. So due diligence. This is probably the toughest part of a transaction, especially for a founder-owned business. Things should not be personal, but they get personal because you're being told maybe your compliance isn't up to speed, or your contracts aren't correct or updated, and your amendments haven't been signed. And so there can be some tension during this process of a transaction, and you want to make it as smooth as possible. Just be prepared for these requests, especially in the private equity world. They will come in, do a deep dive in terms of healthcare regulatory, your material contracts, your malpractice, maybe some obligations under your physician employment agreements. And again, as you're thinking about this, think about it in terms of everything working together. So the due diligence piece really will impact the purchase agreement and could impact purchase price or indemnification. And so know that all along the way that this isn't just a mechanical process. Oh, they need to see these documents. It will ultimately have an effect on what you agree to in your purchase agreement. Next slide. So some of the common regulatory issues we see in a transaction, physician practice management is very unique and extremely creative. And I'm sure, the doctors who practiced 50, maybe 70 years ago had thought of this, but this is a new phenomenon, at least in the last 7 to 10 years. And we're actually making a licensed organization tradable. And so what you need to do in that instance, at least for states that have the corporate practice of medicine doctrine, is you have to create a fiction. And what I mean by that is that the buyer, if the buyer's not licensed, and they typically aren't, well, they can't buy your physician practice. And so the corporate practice of medicine doctrine says, in the states that have adopted it, non-physicians cannot own or employ physicians. Well, so how do you do a deal? Well, you do a deal because what you do is the buyer comes in, sets up a management company, and we'll get into that, where it will transfer certain assets to that management company, purchase that piece of the business, and then have a relationship, a contractual relationship with the physician organization. And typically, and you physician CEOs who have joined us, be ready that the incumbent, you, may not be the physician CEO of the medical practice post-close. It may be someone that's close to the sponsor or the strategic. The fee splitting statute, this is very common in certain states. New York's a good one to look at, where basically says you cannot split professional fees as a percentage of revenue under certain arrangements. Leases are a good example, both in terms of space and equipment. Management contracts are another one. Just things we need to deal with in the diligence process. Going to the next slide. So let's talk about the captive or friendly PC for a minute. Essentially what you're doing is you are going to take your professional corporation and you're going to divide the clinical and the non-clinical assets and split them apart. Again, to deal with this CPOM issue. The sponsor or strategic, if it's a non-licensed physician entity, will own the majority of the management company, right, that's holding those non-clinical assets. They will also appoint a physician, probably a single shareholder physician, to run the group practice. You, as the dentist in the group, will not have much control, nor do you want much control over the group as you do today. And that's something that you really need to get comfortable with, because it's no longer, okay, I'm a shareholder in this practice and I have this say or that say or these rights under our shareholders agreement. It really becomes, I am now, depending on the structure, but let's assume for a minute you have a rollover transaction. I am now an owner in this management company, and that's where my say is, and it has nothing to do with the fact that I'm a physician. You're an investor like anyone else would be. But that's okay, because keep in mind, and we'll get to this issue on the employment piece, but I usually have a lot of nervous dentists and doctors that get, well, if they're controlling this, where do I sit? Again, it's a fiction, and you have to remember that. It's only being done that way because of regulation. You are the primary asset that they're purchasing. They would not want to spend $100 million and then destroy that asset. Turning to the next slide. So some other regulatory issues, you guys may be familiar with these. The first is the federal anti-kickback statute, very broad. It's a criminal intent-based statute. Basically states that any transfer of remuneration, which is essentially anything of value that's not de minimis value, that's paid to induce the referral or the arranging for the referral of business, violates the statute. The elements are it's a knowing and willful, right? It's intent, all for payment, remuneration, anything of value for the return of referrals. It has to be a government program. Commercial programs do not fall under this, although you should check your commercial agreements because many of them have adopted a similar prohibition, have put that in their agreements, and it becomes a breach of contract, essentially, if you violated it. So what are we dealing with, though, with this and your practice in diligence? Again, you may have space or equipment leases, employees, how are they paid, how are they bonused? Personal services arrangements, so we have independent contractor arrangements. Do you have a sales force that is commission-based? Does it meet the personal services safe harbor? You probably have ASCs. How are they structured? Do they fall within the safe harbor under AKS? You also likely qualify as a group practice, which is similar to Stark, one of the few safe harbors under the anti-kickback statute that's similar to Stark, and practitioner recruitment. But my point is, when you get into diligence, and this is all stuff you're going to do before you even go to sell, be aware of these issues, be ready to address them with the buyer during that diligence process. Next slide. So the Stark law, often confused with AKS, right? I hear Stark, I hear AKS, the referral law. So very easy to separate the two. Anti-kickback, it's a criminal statute. It applies to everyone. It doesn't just apply to doctors. It applies to me, anyone who's in healthcare. As long as those elements are satisfied and we're dealing with the feds in terms of reimbursement, you're in the game. The Stark law is a payment rule. And so it basically says if the doctor has a financial relationship with an entity, you can't refer that patient for designated health services, and the entity can't bill for those services unless you fall within a safe harbor. It's strict liability. So failure to fall within the exception or safe harbor means you're on the hook for liability. Unlike the anti-kickback statute, which is intent-based, you don't have to fall within a safe harbor, and you could still be found to comply with the statute. Imaging is a good one for purposes of Stark. Next slide. So what are you typically dealing with in diligence? For your transaction, it's the in-office ancillary services exception. You will often have this referred to as a group practice. Are you a group practice? That's what everyone says. Are you a group practice? One of the elements is in the in-office ancillary services exception is you have to be a group practice, and there are multiple requirements. I think if you combine the two, it's 17 or 18 requirements. Very onerous, but most practices do, and you can do it with effectiveness, and that means your ancillaries are covered. If it also impacts the way you pay your doctors on bonuses and profit sharing, so get ahead of that in any transaction. Also be prepared for a buyer who wants to change that because they may look at your comp system and, you know, especially if there's already a platform deal in, may be looking to change. Just something to think about. Next slide, please. So some other issues that you're dealing with on the regulatory side, we talked about compensation, but really look at your vendor relationships, your independent contractors, management companies, your billing company. See how they're compensated. Are they falling within the personal services safe harbor under AKS? You know, is it at fair market value? Consider those things. What's your relationship if you have an ASC? If you have a deal with a hospital, those will be scrutinized. Now, again, your buyer's going to want to, especially on the ancillary side, because there's a tremendous amount of value, they're going to expand upon those. They just don't want any legacy risk associated with them. And to the extent there is legacy risk associated with them, you may have to deal with it in the indemnification. Always, you'll have licensure issues, change of ownership issues. Next slide. Mike from Provident mentioned this, and it's a really good point. Focus on your billing and coding, but also take some time, especially in the pediatric dentistry world, on the Medicaid piece. And do your own diligence. Are you doing it correctly? Are you billing correctly? We've seen some issues pop up where that could be a significant amount of the business in the pediatric world, and you need to deal with it ahead of time. These are just some examples of issues that do get addressed in diligence. So now, and I'll try to speed things up, now we're going to work to a signing. So and diligence will go on the same parallel track as you negotiating your definitive document. But it's a purchase agreement, typically an asset purchase agreement, because that's buyer friendly. They're not going to take on the liability by operation of law. Notwithstanding that, you may have more difficulty in terms of change of ownership and other regulatory issues on the timing piece. Buyers typically prepare the first drafts, but not all the time. What are some of the issues you should focus on in the purchase agreement? What I always say is you're going to get a set amount of money as shareholders. You want to not only get that, you want to keep it. And so what you focus on is the receipt of that and then the potential clawback post-close by the buyer. And so you need to look at those. And those clawbacks come in various different ways. One could be an indemnification. Another could be under your working capital calculation if you didn't get it right. Another could be a special indemnity because you had a due diligence issue that no one could get comfortable with. Another is escrow, to the extent that you don't have rep and warranty insurance. So just things to focus on in going into the deal. So I want to tie the reps and warranties to the due diligence. So your buyer's going to come in, do all of that due diligence, and then that will impact your reps and warranties and what you're putting on the schedule and what's excluded from the reps and warranties. If you're preparing your practice for the sale, you really want to be in a position where you're very comfortable giving market reps. And in today's market, it's interesting. I'm seeing a lot of different things, but the pendulum is definitely swinging towards healthcare being statute of limitations in terms of survival. And what I mean by that is you have a compliance with law rep, and how long is that going to survive, right? The buyer wants to come back to you for potential indemnification, and it used to be 2 or 3 years. Now I'm seeing it more and more go 6 years, because that's without tolling the initial statute of limitations on false claims. The more you can clean your practice up, the more comfortable your buyer can get in diligence that your practice is squeaky clean, the more it really does impact that transaction document and will help you with negotiations and give your lawyers and your financial advisors leverage in helping you through that process and negotiating a good document. Next slide. This is always a hot topic, and probably one, and Michael and AJ have experienced this, the docs who have joined us probably want to see first before the purchase agreement. It's unusual, even if they don't have an employment agreement today, or they don't have the same terms that they're getting from the buyer today. What I would recommend is know that even if you negotiate an employment agreement up front, and sometimes we're pushed to do that, it is always subject to diligence, and I've never had a situation where it didn't change, and you could potentially be wasting your time. 2 points to look at, though, is the rollback compensation issue, which Provident covered, but you should know and understand how that works. If you're rolling back your comp from 500 grand to 300 grand, and you're going to get an 8 multiple on the 200, figure all that out. Sit down with the accountant, make sure you understand, because it does become difficult sometimes where we get pushback from the shareholders that, well, I didn't know, I was going to be sitting with $300,000 a year in comp, and I may or may not be able to recapture that. Those are details that should be negotiated up front, not the agreement, but just understand how the rollback's going to work. My experience is the sponsors are very flexible there in terms of getting a blended rate. So what I mean by that is not every shareholder, for example, may have to roll back 30%. They may roll back 20, some may roll back 15, others may roll back 35, but they're looking for a blended rate of 25 to 30. Once this is done, you should have your attorney and your financial advisor really present the agreements and the economics to the shareholders. Next slide, please. So quickly, the equity documents, this is why these deals get a little complicated, is because you have a management company and a professional corporation. You're no longer the shareholder in the PC, you're now a shareholder in a management company. And so you want to negotiate and look at that operating agreement because it's going to control your rights and obligations to the purchase price. So let's say you're doing an 80-20 deal where you're walking away with 80% of the purchase price, but 20 is being rolled over. That 20% is at risk. You should know what that document says, who has preference, if any, and how all of that works. Also address issues, and usually sponsors are pretty flexible here. If you have retiring doctors or associate doctors on the bubble that are about to become partners, how does rollover work for them? A lot of times I see that retiring doctors aren't required to roll over and associate doctors are given the opportunity to roll over. And then the reorg of the company. Obviously, if we're going to have a management company and a PC, the lawyers need to get in there and do a reorganization of the company. Governance, next slide, please. Governance and approval for signing. I've done this in a couple of deals. I've said a few times, you're not going to really control that PC, but you may have an opportunity to get a physician committee where you have some input on material physician employment issues. And that's where, I've really, I think, solved some tough issues between a sponsor and a DSO where they just can't come to terms with the fact that I have to trust this organization, right? It's all about trust. So we've put together some physician committees where a legacy doctor may have a seat on a committee and have some input as to the day-to-day, because usually that's what the dentists are concerned with. And then obviously you're going to move to shareholder approval. That gets presented to the shareholders, and the approval is usually done before the meeting. Otherwise, you wouldn't have the meeting. And real quickly, signing to a closing, that's all of the things. It's called the executory period, and all of the things you need to get done to close the transaction. And it's chows, right? It's consents. If you have a supplier or a wholesaler or a payer where you need a consent to their assignment of their agreement, there's 30, depending on how long that executory period is, you get those consents in. There's also closing deliverables. And so you'll have the board that authorizes the transaction, employment agreements that are delivered, payoff letters, and perfunctory stuff, debt termination and landlord consents. Once all of that is satisfied or waived by both parties, depending on who has the right, you then close the transaction. So Michael, AJ, Gina, that's all I have. I'm done in terms of just walking them through the process and the regulatory issues.
So now we'd be happy to open it up to questions. And again, you can put questions into the Q&A box, which is likely located at the top or the bottom of your screen.
Yeah, so I have one on the legal side. It's just, aside from the legal issues, what is one of the biggest challenges you see in these deals? I think one of the biggest challenges I see is just managing expectations of the partners who may be at different points in their career. So you may have someone who's, for example, 35 years old and an up-and-comer as an associate dentist and really trying to make their way versus someone who's retired or someone's on the bubble. And that impacts compensation, that impacts rollover, it impacts non-competes. All things you need to really pay close attention to. But, you know, I mean, Michael, I think, said they've done 45 of these transactions. Clearly, the strategics and the sponsors and the DSOs are getting very comfortable with those issues. But that's one of the biggest challenges. It's not a legal challenge. It's really managing partner expectations at the shareholder level.
We have another question as it relates to payer mix and how does that affect valuations and revenue pricing multiples. I'd say as it relates to a larger Medicaid population versus pure cosmetic dentistry or private pay, I'd say that it's kind of low. It depends on the geography. Obviously, that not all Medicaid. Some states have better Medicaid programs than others. As I mentioned earlier, we completed a pediatric Medicaid deal a couple of years back. That was, you know, their reimbursement was in line with the commercial payers in the area, and the multiple was in line with the commercial deals that we had done in the past. That being said, I would say a pure play Medicaid practice is typically, if it's, you know, non-pediatric, will likely have some sort of discount to the where commercial commercial deals are trading. You know, I think most states the reimbursement on Medicaid for the general population is lower than the commercial pay, and you will see, you know, it could be as much as you know, a two times multiple lower as far as the kind of the overall valuation of a business for a Medicaid business versus a commercial pay. But you know, it does have to do with the geography and what the Medicaid in that particular state looks like.
Yeah, I have another one. It says, what are you telling partners who may be concerned that they will be terminated without cause post-transaction? And this is an extremely hot topic in every transaction that I'm involved in. And it's a fair question. So a few points I want to make. One, check your existing employment agreement if you have one. A lot of times one doesn't exist. And so I typically say, well, what do you have? And that's not the end game, right? But what do you have today versus what are they offering you? The next point, though, is, and it's an important one, typically a buyer comes in and wants to put that without cause termination on you because they do not want litigation in a for cause situation. It's always difficult to prove. It creates problems, it creates litigation, so they want the for cause. And again, that's still tough getting comfortable with. But it goes back to my earlier point, why would they terminate you if they just bought this asset for 50 or 75 or $100 million? They wouldn't, right? You are the asset. Very tough, though, for people to get comfortable with. But again, I haven't really experienced any transactions, and Michael, you can jump in here, or AJ, where they come in, buy a practice, and then terminate their employees without cause.
No, I'd say that's correct. I think you mentioned it earlier. The dentists are the producers who are, you know, producing the revenue and EBITDA that they're buying. So that would be counterproductive. We have another couple of questions that relate to working capital and kind of the negotiation of working capital. I'd say that, you know, the vast majority of especially founder-owned businesses are on cash basis financials. And during due diligence, there'll be a cash to accrual conversion. And working capital is, that balance sheet. The partner or acquirer will be looking for a kind of a normalized level of working capital. They don't want to acquire a business and then day one have to put additional dollars in. That would be essentially increasing the purchase price that was agreed to. So the working capital number, they're looking for kind of a normalized level of working capital, whether that's 30 days, 45, 60 days. It's typically somewhere in that range. They, once the accrual conversion is done, we'd look back at kind of what the normalized level has been for that time period, and negotiate a number that's fair to both sides. It's not supposed to be a windfall where they're getting additional dollars or that you're getting additional dollars. But to the extent that there's a situation where you've left not a normal level of dollars in the business, and you're an independent owner and you've left excess working capital in the business, we would absolutely negotiate around that number to make sure that you're getting credit for that. And I think a second part of, or a separate question, was around kind of collections pre-deal AR and kind of deferred revenue and orthodontics practices. And this is something, I think that the collections of pre-deal AR, that's taken care of in the cash to accrual conversion, because you're getting credit for that. The revenue and the EBITDA and the subsequent receivable would be part of that as they build out the accrual balance sheet. On the deferred revenue on orthodontics, I think there's different groups look at that in different ways as far as what kind of their the way that they recognize revenue on the orthodontic side. Typically, I think most of the strategics and quasi-strategic acquirers do not recognize 100% of that orthodontics revenue up front. So, possibly they'll recognize 50% of that revenue up front and then a certain amount over the next 12 to 18 months, but it varies by group. But typically, 100%, since there's additional work that needs to be done moving forward, the revenue recognition on the orthodontics piece would likely be a percentage up front, and then subsequently for the following 12 to 18 months would be recognized. AJ, feel free to fill in on anything I missed there.
No, I think that was a good answer. I think, the orthodontic piece in particular is something that we've seen to be pretty kind of malleable and different in terms of viewpoint group by group. I don't think that there's kind of a standard gap way of looking at that from what I've seen so far. So, but I think Michael's point is correct in that, you typically don't see 100% recognition at the time of the start. It's more so kind of deferred over time with some amount, some percentage recognized up front.
And we are actually just about out of time for today. If anyone has any additional questions, please feel free to reach out directly to any of our speakers. Their contact information is displayed right on the screen. Thank you so much, everyone, for joining, and enjoy the rest of your day.
Thanks, everyone.